It was an interesting day in the markets today with S&P 500 falling by about 1.6%. We saw the Nasdaq down even further. There was an interesting pattern that formed today on the S&P and the Nasdaq when you look at the weekly charts. Here's your bearish engulfing pattern on the Nasdaq, and here's your bearish engulfing pattern on the S&P on the weeklies. So I think those are somewhat important. It does not often that we get to see bearish engulfing patterns on the weeklies. It has happened more recently. This just happened in February, and it also happened again in March. So I think that's worth pointing out. It has happened obviously in other periods of time as well. Here would be another such example, just barely, but again, a such example. This was in July of 2023. And then, of course, if we go back to December and January of 22. So it's worth paying attention to this, and it could be a sign of some sort of inflection point in the market. It could turn out to be nothing, but again, it's something that we don't see very often on a weekly chart, and it's something we want to pay attention to. And what's really interesting, I guess, about the Nasdaq specifically is that the Nasdaq just yesterday was basically sitting at basically extremely overbought levels on the monthly charts. Had an RSI of 72 and was just barely above the upper Bollinger Band. Again, it doesn't normally happen that you see on a monthly chart a condition where you have both the index trading above the upper Bollinger Band on a closing basis, and you have the RSI above 70. Again, it was just barely, but it still happened. And so the last time you can really identify that, August of 2020, we obviously went through some rough periods of time thereafter. We had an overbought condition. And obviously, when you look here, you can see this also happened in January of 2020, where we were overbought on the monthly on both the RSI and the Bollinger Band, and also January of 2018 were a couple of examples. So again, kind of telling us that this market was overbought going into the end of going into the end of this month. And interestingly, yesterday we ended up giving back a lot of the gains late in the day. Otherwise we would have seen it close much higher, and that's why it was as close as it was. So I think this is important to take note of. Also, what I found really interesting too is when you look at the S&P 500 futures and you look at it on a monthly chart, really interestingly is that the volume levels in the month of July were extremely low as well. In fact, when you look at it and you go back over time, this was one of the lowest levels of volume traded in a month since August of 21. And that obviously we had a rough September of 21 that year. So again, not very often that we have these types of periods of such low volume and these overbought conditions. And all it really took today was for some of the sellers who've been sitting on the sidelines to show up. I mean, clearly this was the strongest volume day we've had in quite a while, and you can see the volume has really been building up the last couple of days. And so again, not really surprising that once the volume returns, you see the pressures of the market really kind of come back. It gives us a sense of what kind of environment we've really been in. And so when you look at that, I mean, clearly there's some decent support around the 6100 area. The lower Bollinger Band is going to probably come down over the next couple of days, and so this will act as a kind of a support level. If we manage to get to 6100, that's really the bigger area. But more interestingly is that we closed below the 20-day moving average, and we also closed below the 10-day exponential moving average. So when you look at the 20-day moving average, this was really the first time we've closed below the 20-day moving average. Really, you got to go back to April 24th to find a close below the 20-day moving average. So this was an important close. I guess notice also that you had this gap higher above the moving average, and in this case you had a gap lower below the moving average. Not sure if that will mean anything in the end, but it's an interesting thing to note. The other thing that stands out when you look at this chart is that you also have you had this big uptrend in it that also broke today, and that we gapped below that as well. There's also here, you can see this basically has formed what looks like a rising wedge pattern. So again, a lot of the ingredients were there for a pullback, and it's just really a matter of how big of a pullback this can ultimately be. As we've spoken about on numerous occasions, realized volatility levels were extremely low over the last month or so. I mean, just really, you haven't seen 10-day realized vol this low in a really long time. And basically, we're at levels that we're bound to see some sort of rebound and rise in volatility. And even implied correlations were also extremely low. And in fact, when you look at the 1-month implied correlation index, which is something we've talked about here occasionally and something we've gone over ad nauseum in the members area, but basically, again, this was telling us pretty much that we were at a point in the cycle where, with implied correlations really depressed, that we were bound to see them go higher. Once you get past earnings season and you get past the big companies that report, implied correlations tend to go higher. And so that was also telling us and giving us a signal that we were probably coming to some sort of turning point. And you can really easily do that by just typing in VIX on Apple. And here you can see it pretty clearly that the implied volatility levels were fairly elevated going into earnings, and they immediately drop right after earnings. If you do the same thing for Amazon, same thing in here. So if you take the VIX index and you overlay it with these implied volatility levels for these stocks, notice that there's this period in time where you get these rises in implied volatility. And in this case specifically, you had the rise in implied volatility, and you had the implied volatility of the index moving lower. And so that's part of the volatility dispersion trade that goes on heading into earnings. And that's what drives the implied correlation index sharply lower. And then when these companies report, the implied volatility level of the stock drops dramatically, and then they start trading again for a period of time with the index, and that pushes implied correlations back up again. So this is just kind of a mechanical aspect. On top of that, we also know we have the TGA drain going on right now. We talked about that last week. We've been going over that a lot in the members area. So that's also another factor, basically liquidity getting sucked out of the marketplace due to the bill issuance that's taking place. And remember, this year isn't like the past years, because this year we don't really have any money in the reverse repo facility to offset the rebuild of the TGA. You can clearly see that the reverse repo facility has really been drained to the bottom of the barrel here. And so the last time we had the TGA really rebuilt, which was in June 23 into November of 23, you had reserve balances declining by much more than what was being added to the TGA. And this reserve balance decline basically funded the TGA rebuild. You're not going to have that this time. And so it's quite possible that we're living in an environment that was more similar to that of 2022 when it comes to liquidity in the marketplace. And in 2022, you had this rise in reverse repo facility. You had the rise in the TGA. That really led to a fairly sharp, drawdown in the market right until May. And then in 2023, you had the TGA rebuilt, but again, kind of offset by the decline in the reverse repo facility. Now the reverse repo facility is emptied. TGA was drained due to the debt ceiling. Now you're seeing the TGA rebuilt. And so again, it's quite possible we're going to be more in this type of environment than we're more likely than to be in this type of environment. But again, we're going to have to just kind of see how that plays out over the coming days. And generally speaking, what I try to keep an eye on is the size of the TGA, and also I keep an eye on what's happening with SOFR. And so SOFR moved up by 7 basis points to 439. Probably comes down a little bit on Monday, but again, depending on how this liquidity situation goes on, we could really see this number stay sort of elevated at the upper end of the range, especially as more T-bills are issued and those T-bills settled. That could play a role in this as well. So anyway, I hope you have a great rest of your week. Please remember to subscribe to this channel, like this video, share it with your friends, and we'll see you again soon.